Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is June 23 and this is a weekly markets update. Let's now look at the news of week 25 and see what are the next trends. It was another week of escalation between Israel and Iran that peaked with US strikes of Iranian nuclear program objects yesterday. Commodity markets responded with surging prices, and this trend will continue this week as escalation is not over. Urea was influenced the most among all fertilizers markets. Egyptian urea production is down due to Israeli gas supply disruption. Israeli Energy Minister indicated last week that gas supply can be restored as soon as security situation normalizes, which means perhaps that it will not until the conflict is solved somehow. Iranian urea production is also down, obviously, so price rally was finished on Friday with sales of 25,000 tons of Algerian urea at $536. Before that, Algerian producers were selling smaller lots, increasing the price constantly. Total volume sold during the week is evaluated around 200,000 tons. Nigerian producers also used this opportunity to significantly increase prices, which are now evaluated around $420 and more if you use Brazil as a netback basis. Middle East producers were not active in spot sales last week, except SABIC, who conducted the highest sale at $450 FOB for July shipment, the level unseen since the end of 2022. Chinese granular urea was sold around $400 FOB, but during the week bids at $420 level were rejected, so clearly the price level will further increase. Supply from Russian producers was affected, with two Eurochem plants, Novorossiysk and Novonosiysk, being out of production due to drone attacks. As per bits and pieces of market information, both plants might come back on stream within upcoming week or two. So, general effect that global supply-demand balance will not be dramatic. SOCAR has loaded a tender last week, but it was scrapped and shifted to later due to escalating turbulence in the international market. European demand was thin, obviously, but some buyers in France and in some other markets were inclined to purchase small volumes for stocks, anticipating further price increases. Turkey will suffer the most from the supply disruption caused by Israel-Iran confrontation. The vast majority of its imports arrived from Iran and Egypt during past years, and now both sources are unavailable. Two vessels with Iranian material are underway. One is definitely sold out, perhaps the second one will be also very soon. However, for further purchases, Turkish buyers will need to pay up. Part of the demand might be covered with Russian tons as soon as they reappear in the market. But Iranian supply flow will be extremely difficult to substitute. Usually, Turkey purchased between 400,000 and 600,000 tons of urea during summer months. So, even in case of imports decrease by, say, 30% to, let's say, 300,000 tons, still in current circumstances, it will be a tough task to find supply. Some Central Asian supply might help, but it is not able to cover it all. In Latin America, offers were progressing sharply during the week. In Brazil, deals were done at the level of $460+ CFR. Several cargoes of Chinese urea was sold to Brazil, and it is the first time in several years that Chinese volumes are traveling there. Level for Central American markets and Argentina were heard even higher than that. In Ethiopia, EABC received offers from 5 trading companies in its June 18 urea tender for 260,000 tons. Most of the offers were basis Chinese material, and price level varied from $387 to $430 FOB. There were no awards done yet. And finally, let's move to the Indian tender result, which is no surprise, of course. Only 2 lots that were automatically confirmed will go to India, which is only 229,000 tons at $399 CFR West Coast. It means that India needs to retender soon, and global market situation doesn't look favorable, of course. But as we have seen many times in the past, India will purchase anyway, at any price level that is available, because having product available for the farmers at the right time is a political question rather than an agricultural one. So I think we will see the retender in the upcoming 2-3 weeks. Of course, it will depend on further geopolitical events in the Middle East. But if no significant escalation follow the US strike, this timeline for the tender would be my guess. Paper values continue to crazily increase. Egypt FOB future price for July and August jumped by more than $80 to the average of $485 FOB. Arab Gulf FOB future price again corrected by more than $40 to the average of $463. Similar correction happened for Brazil CFR to the average of $475. NOLA values jumped by more than $60 to the average of $435 per short ton for July and August. But at the moment, situation is so fluid that exact levels don't mean anything and significantly change literally every hour. Ammonium sulfate market was very active last week, with prices increasing globally by $20 and more per ton on the back of urea price increase. Chinese standard AMSUL price rose sharply to $175 to $85 FOB, and the sentiment continues to be bullish. For compacted product, prices climbed to $190, $95 FOB. And these levels were supported by demand surge in Brazil and Central American markets. The general uncertainty in the market is pushing buyers to secure the cheapest nitrogen source available at the lowest possible price before it will increase more. In Brazil, the impressive amount of 250,000 tons of compacted product, or even more, was traded last week at price mostly around $200 CFR. And at the end of the week, sellers were offering already around $220. In Central America, the tender was closed for 22,000 tons of copper grade at $191 CFR and 11,000 granular product at $203 CFR West Coast. The origin is China. In other markets, purchasing interest also picked up, but no sales were registered. In Egypt, several domestic buyers stepped into the market with a total demand of at least 50,000 tons of product for July shipment, taking into account no availability of urea. This inquiry will be covered most likely from China, but details are still unavailable. So, AMSUL might partially substitute immediate hunger for urea in certain markets, but of course it will drive its price further up. The nitrates prices continued increasing on the back of growing urea price. Ammonium nitrate is focused due to the shutdown at the plants in Russia, with prices having surged by $30 to $80 per ton on supply tightness. However, Russian plants, as I said, are expected to come back on stream in about a week, so the effect of the global supply-demand balance will be not that dramatic. Prices in Europe showed signs of upward trend, although there were no new price announced so far. Producers are mostly on the sidelines, evaluating market situation and trend. Anyways, European demand is completely finished for the season, so producers have time to build their strategy. Tunisian GCT still hasn't announced results of its annual ammonium nitrate tender. We should hear from them this week. Egyptian buyers are also interested in nitrate on top of sulfate for supplying June-July to offset supply problems with urea during application season. The inquiry circulating in the market is for 50,000 tons. Ammonia market was not significantly impacted by geopolitical tensions, despite loss of Iranian and Egyptian export flows. In fact, the only markets that will feel this disruption will be India and Turkey again, while other markets will easily substitute from other sources. Thus, there was only modest price increase in the international ammonia market last week. The other problem that might appear if Israel-Iran conflict escalates further, or is not finalized as soon as least, is transportation cost increase from the Middle East, as vessel owners might charge additionally for the risks of going through the Strait of Hormuz. However, it is the tomorrow's problem for now. East of Suez, producers are now targeting $300 and more FOB for fresh loadings. There was no spot business heard in the region last week, while contract flows are ongoing. However, Indian demand clearly will support regional business in July. Iranian product usually makes about 20% of Indian supply, so it will need to be substituted, taking into account that downstream fertilizers production in India is at its seasonal peak now. West of Suez, there was no fresh spot business registered as well. Delivered price to Europe climbed by around $10 to the level $435 to $55, duty paid. In Turkey, nominally, the prices remain stable. However, it is clear that without Iranian supply, country will need to pay more for sourcing from other origins, such as US, for example. Current CFR level is estimated at $400 to $420. In the US, export price increased by $5 to the level $340 to $50 FOB, and export availability for July seems to increase as well. Domestic season in the US has ended, so local prices decreased and stocks are being cleared out. Phosphates market was also not directly affected by geopolitical tensions, apart from fears regarding potential supply hiccups from Jordan. Still, this didn't happen. However, the bullish trend continues, supported by Indian demand. Last week, the highest India CFR price reached over $800, new psychological barrier. This sales of 50,000 tons was reported by OCP for July loading. Also, Ma'aden informed the market about sales of 100,000 tons at $775 CFR India. In addition to that, RCF confirmed purchase of pure freight cargo also at $775 CFR. So, seems like higher price is not a barrier for Indian purchases. In Pakistan, there were no fresh purchases, but offtake during current Kharif season jumped by more than 40% versus a year ago. Thus, Pakistan will also need new cargoes very soon, which will only support the bullish trend. At the same time, worsening affordability is definitely a problem for the domestic farmers. So it is a question how large will be the demand this season at all. Demand from Ethiopia is one more factor of price support. Last week, EAPC received offers for its restricted tender from 3 traders. All volume proposed was from China, at prices in wide range of $720 FOB to $770. Europe was purchasing mostly OCP product last week at price levels similar to a week ago. In the US, the market activity was rather quiet, while prices increased in line with the global sentiment. DAP price increased to $720 to $25 FOB, NOLA per short ton. MAP price was valuated in the wide range between $730 to $50 FOB per short ton. Meanwhile, phosphates affordability keeps worsening and now is at a historically low level in the US. In Brazil, farmers are also resisting constantly increasing phosphate prices, but there is not much they can do. Still, the demand is there, even if more limited. Last week, OCP reported sales of 30,000 tons of MAP at $760 to $65 CFR to Brazil. Clearly, this level now is far from farmers' expectations. But closer to the actual application season, perhaps this will not look that high anymore. In China, DAP offers climbed again to $730 to $50 FOB. Total Chinese DAP export this year reached only modest 92,500 tons in 5 months. In order to really support international market and ease supply situation, China needs to significantly intensify export inspections. In the whirlpool of geopolitical tensions of last weeks, I haven't mentioned important news that happened in the potash segment, so let me correct this now. 2 weeks ago, long-awaited annual contracts between India and 2 major producers, PPC and Uralkali, were settled at the price of $349 CFR with 180 days of credit. This is $66 higher versus previous year. Together, 2 suppliers will deliver 1,250,000 tons of standard product. Also last week, Indian APL concluded a contract with Jordanian APC for supply until the end of this year. Price level is the same that with Russian and Belarus suppliers. Then, a week ago, China has settled its annual contract with Uralkali at the price $346 CFR until the end of this year. This level is $73 higher versus a year ago. So, now the direction in the potash segment is also set. Moving to the fundamentals. European natural gas futures continued increasing amid uncertainty and fears of conflict escalation. Though Europe currently has adequate supplies, its dependence on global LNG makes it vulnerable to geopolitical shocks. A major concern is that Strait of Hormuz, a choke point for about 20% of global LNG and oil shipments. If Iran blocks the strait, Qatari exports, which supply nearly 4% of Europe's gas, could be affected. Additionally, hotter than normal weather across Europe is boosting demand for cooling, with forecasts showing above average temperatures and peak air conditioning use expected in the coming weeks. US natural gas futures also surged during last week and reached the level of beginning April. Forecasts for a major heat wave across the US, with triple-digit temperatures expected from Chicago to the East Coast, are driving expectations of record-breaking demand. And geopolitical tensions, of course. Average US gas output in June stands just slightly below March record. The Energy Information Administration reported 95 billion cubic feet storage injection last week, smaller than expected, suggesting tighter supply. Agricultural commodities future prices moved differently last week. Wheat futures rose to $5.7 per bushel, the highest level since end of February, supported by a slower than average US winter wheat harvest, which has reached only 10% completion, well below the 5-year average of 16%. In Europe, France Agrimer raised its forecast for French soft wheat exports both within and outside the EU for the 24-25 season. However, due to a rain-damaged harvest, France, the EU's top grain producer, still faces the prospect of its worst wheat export campaign in decades. Meanwhile, traders are also keeping a close eye on US-China trade developments. Corn futures slipped toward $4.3 per bushel as a glut of supply collides with seasonally subdued summer demand and forecasts for record harvests. In the US, the USDA's record estimate of corn harvest, alongside renewed rains and warmer temperatures in the eastern Corn Belt, has cemented expectations of a bumper yield. At the same time, Black Sea exporters are poised to ship about 46 million tons in 25-26, up nearly 40% year-on-year, thanks to expanded acreage and favorable planting conditions in the region. This creates a deep US dollar per ton discount on new crop offers and stifles forward buying. In Brazil, upward revision of this marketing year harvest further bolsters global supply projections and adds downward pressure on prices. Soybean futures stabilized around $10.7 per bushel, supported by strength in soy oil and the broader energy market. The recent rally in crude oil, fueled by geopolitical tensions, has boosted the appeal of soy oil as a biofuel feedstock, enhancing demand for soybeans. Additional support came from a proposed US Senate Republican tax bill that would extend the clean fuel tax credit through 2031, but reduce its value by 20% for biofuels made from feedstocks sourced outside the US, which is a potential tailwind for domestic soybean. Meanwhile, traders continue to monitor US-China trade relations as soybeans were not included in the latest bilateral agreements, leaving questions over Chinese demand unresolved. Moving to the shipping industry. Containerized freight index dropped last week for the first time in over a month, following 6 weeks of gains, mainly due to the low demand for US-bound cargo. It is a sign that the recent surge in imports to the US, which occurred after the temporary halt of higher US tariffs, will fail to have the lasting impact that the market had initially expected. Freight rates from China to US dropped significantly, between 10 to 20% depending on the route. Freight rates from China to Europe, vice versa, increased by around 10%. Still, the main factor of uncertainty remains final US tariffs regulation, including those for vessels entering US ports. The Baltic Exchange Trade Index dropped back to the level of beginning June amid slow activity across segments and basins. The Capesize market trended downward with sentiment consistently softening, particularly in the Pacific. For the Panamax sector, it was also a subdued week. Transatlantic trades were few, and a general decline became evident in both grain and mineral demand in the basin, while the Asian market continued to ease. For ultra-supermax segment, it was a rather positional week. The Atlantic saw better demand, while the continent Mediterranean, by contrast, lacked much impetus. In the Asian arena, it was a slow start, although as the week progressed, better levels of inquiry were seen. The handysize segment activity was rather quiet. In the continent and Mediterranean, conditions remained soft, with limited fresh inquiries, and Asian markets remained subdued. To sum up, whirlpool of geopolitical events continues pushing commodity prices up, and there is no sign of situation settlement as we speak. Urea production in Egypt and Iran are completely halted, which creates a major problem, especially for Turkish and Brazilian buyers. As a result, urea price in Algeria surged to $536 FOB on Friday, in the Middle East to $450 FOB. With India that will need to retender and Brazil approaching main purchasing season, we might see much higher prices soon, despite affordability hitting its lowest level in years. Chinese exports seem to progress, but we will see the actual readiness of China to export significant amounts already in July. Ammonium sulfate price surged last week on the back of incredible demand from Brazil, where buyers are trying to fight affordability issue with lower nitrogen content products. Nitrates prices also increased, but rather nominally. Phosphates prices increase is not even in use anymore. Last week, new psychological barrier of $800 CFR for DAP to India was taken, so sky is the limit. The demand is in place and prices will continue growing. Gas price in Europe increased more, both as a response to the escalation in the Middle East and also due to high temperatures across Europe. Hot weather affected US gas price increase as well. Agricultural commodities future prices moved differently. Supply concerns supported wheat price, while exactly opposite situation in the corn market drove the price down. Container shipping activity decreased as a result of demand reduction from China to US. That followed a rise of last week's. Bulk shipping activity was mostly subdued across segments. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.